it is quite nice to have some people to talk with. So for the purposes of my section, I want to focus on business risk management, but specifically in relation to the three aspects of business risk management that every business should have in place or at least consider. Now, I call it the big three. That does not mean that there's only three. There could be a lot more than three. But for the purposes of our presentation, we'll just extract what is the most important three. Now, the first thing that business entities usually ask is, what am I going to do as a shareholder or as a member when something happens to me? What happens when I die to my specific shareholding? And usually, business continuity ranks very high. And that is where we usually propose for business owners where there's more than one, sometimes even where there is one, to have a look at a very specialized and specific agreement, which we call a buy and sell agreement. Now, this agreement has got a bit of an interesting name because you usually think that you're buying and selling at this very point in time, but that is not the case. So when we have a buy and sell agreement, we in practice very often refer to that buy and sell agreement as a business will. Now that already should tell you something about what this agreement does. Because for you to have a will, you are obviously very concerned about what is going to happen to your assets should you die. And this is also what that buy and sell agreement does. Now let's make it interesting and practical. We are two shareholders in a specific PTY Limited, and we are very concerned what is going to happen to our shareholding should one of us die. Now, usually the other shareholder does not want that shareholding to go to my family members. I promise you it's going to be an uphill battle to run a business with my son. So you obviously want to make 100% sure that should something happen to me, you are in a position to purchase my specific shareholding. My family members will not have a problem with that in most instances because they do know that my executor will have to sell that specific 50% shareholding to another party. So they do get the correct proceeds for that specific membership interest or shareholding. Now, people often ask, this business will, this specific contract that regulates what will happen and who will sell to whom at death, does this only apply to death or not? Now, the answer there is that there can usually be two trigger events in your specific buy and sell agreement. Now, a trigger event is the event that will activate this specific buy and sell contract or agreement. And those trigger events are usually death or disability. It does not necessarily have to be only death, it can be disability as well. But if you don't want to sell your shareholding when you become disabled, you can formulate that agreement to only apply to instances where you die. So yet again, that business will needs to be in place for those secure businesses to see that continuity in that business is adequately provided for. But a buy and sell agreement usually needs a funding mechanism. It does not make any sense to have a buy and sell agreement and to obligate my executor when I die to sell the proceeds, but you who are going to buy my proceeds have no funding. So very often the funding mechanisms for those buy and sell agreements are life policies. Now let's put that in an easy way. A will take a policy on my life and I will take a policy on his or her life, simply because we don't know who is going to die first. So we have to risk manage by having two policies, the one taking out a policy on the life of the other and vice versa. Now, the most interesting thing, and this is something that I think clients often do not do, even if they have those buy and sell agreements in place, you have to make sure that the funding mechanism is equal or aligns to your value that you hold in that specific business. And therefore, most agreements make provision for the fact that on a yearly basis, that business should be revalued, and you have to make very sure that your funding vehicle still aligns to the value of your business. Let's put it bluntly. It doesn't really serve a good purpose if my percentage of the shareholding is valued at 100,000 or a million. Let's take a million. And you who want to buy my shareholding only have cover on my life for 500,000, because then we're only halfway there. So where are you going to get the residue, the other 500,000? Because you have to buy my shareholding on my death for what it is actually worth. So yet again, people ask me, how many times should I relook at my buy and sell agreement? And I always explicitly says it's not like a normal will. A normal will can be reviewed every 2 or 3 years unless something happens in the interim. But a buy and sell agreement and the valuation of your interest has to be revalued on a yearly basis, and usually after your latest set of financial statements has seen the light. So that for me ranks as maybe the highest or number one in our business risk management elements. The second thing that I quickly want to touch on as well is that most businesses need to be funded. And you are in a later presentation also going to hear what is going to happen when businesses find themselves in a negative situation. But most businesses need to be funded, and funding usually happens in one of two methods. You, as a specific individual, decide that you are going to make a loan to your business. So you actually put your personal funding into your business. Now, in the statements of that business, it will usually be indicated that the business owes you this amount of money. And we call that a credit loan account in the books of that specific business. So what happens with credit loan accounts? They are treated very much to a similar effect than any loan that you would make to any other person. So that loan can be repaid during the course of your life, but usually that loan is not repaid by the time that you die. So think of it logically. What would happen then? Your executor in your estate will be able to claim that amount that the company or the CC still owes you on that specific point in time. Now, I don't know about you, but I don't come across a lot of entities that can afford to repay those credit loan accounts to the estate of that deceased shareholder. So usually what we do, and this is our opportunity number two that we always have to look at, is that there is adequate funding in place for that entity to ensure that on the date of my death, they can actually repay my executor the amount that that company is still owing to me. So a very important element, and something that we always look at, and a risk element that we always point out, is when we look at those financial statements, the first thing that we do in the financial statements of any company or any CC is we go and look at whether there are any credit loan accounts and what we can do to ensure those specific credit loan accounts. Now, people often ask me, Melanie, what can we now do with these credit loan accounts? Say, for example, you die and you have placed 500,000 into that business. This business would in all possibility not be able to repay your executor on the date of your death. So there are certain options that we can follow here. The company can obviously insure my life. So when I do die, they will immediately have the funding available to repay my executor that specific amount that the company is still owing to me. Now, yet again, loan accounts fluctuate because very often a company would need more funding. So what would I do? I would, as a director and shareholder, very often take more of my personal funds and lend it to that company. Otherwise, the company can decide that they are in the financial position to partially repay my loan account. In those instances, my loan account would lessen. In the first instance, it would increase. So it remains important, similar to the valuation that needs to be placed on my shareholding on a yearly basis, that we have a look at the amount of risk by looking at whether those loan accounts fluctuate, increase, or decrease. We can also do some other things with those loan accounts. Very often in those buy and sell agreements, the shareholder that remains will also purchase my loan account, not only my shareholding, but also my loan account. And in those cases, we add it to the specific buy and sell agreements. So there's a lot of things that we can do with those specific loan accounts. The only thing that we cannot do with those loan accounts is we cannot ignore them. They are of utmost importance because they raise a little red flag, and that red flag says there's a risk here. Now, in the last instance, and I'm just highlighting our third option, is that very often, and I suspect this in the current economic climate, is going to become more and more interesting. And I think clients are going to keep on asking what their personal risks are, because very often I don't put my own money into the business. There's another method to fund a business. There's usually just two. Either A, I put my own money into the business via a loan account, I lend it to that specific business, or alternatively, the business goes to a financial institution, such as a bank, and they ask for facility. Now, when the banks provide that type of funding, let's call it third-party funding, to that specific entity, the banks will obviously ask for surety. And who will sign that surety? In all possibility, one or two of those shareholders. So they sign that surety in their personal capacity. So they stand in for the company or for the entity when that company or entity cannot repay that specific facility. Now, the third thing that we usually say is opportunity 3, that ranks rather high, is that when a person, a shareholder, a director has signed surety for that business, the well-being of that business would be of the utmost importance for him or her. Because if there are any issues regarding the well-being of that entity, I run the risk of being called in to make good. Now, in our world, where we normally focus not only on life, but on death, we unfortunately have to look at how we can ensure this specific surety that I signed. If my business gets a facility from a bank, one of the big four, and the banks provide that facility to my entity, they will look at me to provide for surety. And I will provide that surety in my personal capacity. So I'll sign a surety agreement. But what happens now? Under which instances can that specific bank come and call up that facility in my estate. I'm now deceased. Usually, the entity will go hunting around the company, looking for somebody to replace me as surety. But I can't see a lot of people putting their hands up now to replace me as a surety in these dire circumstances, economic circumstances. So what would usually happen? The bank can come to my personal estate, and my personal estate is at risk. Do I have my personal estate enough liquidity for that specific surety? The fact that I can reclaim that means nothing if that business does not survive or if that business is not secure. So what we often look at here, and this is where I'm going to conclude, is to say that we here look at yet again providing funding and insurance to cover against those risks. And how we do that? Twofold. Firstly, we enter into an agreement, the company and me, the person who provided surety, stating that that company will insure my life for the amount that I stood surety for. And if that unfortunate situation materialized and I'm no longer there, the funding will pay out to the company, and the company will repay the financial institution. Now, I always say there's two things needed here: a properly drafted contractual agreement in the first instance, and secondly, having the necessary, bless you, Marina, having the necessary funding available as well via that specific life policy. So, Conrad, just to conclude, usually when we look at businesses and we look at their solvency and whether in this COVID environment they are healthy, they are stable, or whether they are ill or maybe terminally ill, we actually firstly look at those financial statements and we extract these big three items which we regard as the greatest risk of any company. And that is it from me.
Well, Melanie, thank you so much. I think to put all that information, and I work with you quite a bit, to put all that information into 10 or odd minutes is very difficult. And I think that's exactly the point, is this is just a little bit of an insight to the world of what a business will and everything that is in your finances entail. It's not just growing up finances and giving it to SARS. It's actually making sure that it actually takes care of every aspect, including your own estate, not just that of the business. But you did allude to the fact that people are making loans, whether it's to the company themselves from their own money, or whether it's from a surety mechanism from a bank, and that just in a current stage where we're looking at SAA and we're hearing about this money that's being owed, whether it be to a bank or not, brings up a lot of different other things that we need to look at from a business owner's perspective. The business owner will probably want to know, I can't continue. I want to continue, but I don't know how to continue. I'm dealing with this debt, and how do I rescue my business, or do I just call it quits? I think if Marina can maybe come in here and just tell us a little bit more about the options available to the business owner.
Thank you, Conrad. Yes, there are pretty much three options. Number one is, of course, you trade your way out of it. It is really the hardest way, and it's not something I'm going to discuss for purposes of this webinar today. I'm here to discuss and give some information. It's going to be very limited, though, because of the time limitations on business rescue as one option, and then on the other one, liquidations as the other option.
So you're saying that business rescue is an option. There's a physical process that can be followed for a business owner to try and save their business, to try and save their employees, to try and save what they've built in the past. Maybe you can just spend a few minutes on what business rescue is.
With pleasure. Conrad, business rescue is the buzzword these days. I think everybody would have seen that Edcon, the whole Edcon group, decided yesterday to also this rescue. SAA has tried business rescue it hasn't worked for them. They're most likely going to go into liquidation very soon. But what is business rescue? Business rescue means proceedings to facilitate the rehabilitation of a company that is financially distressed by providing for three things. And those three things are: one, the temporary supervision of the company by the business rescue practitioner, and that person then steps into the shoes of the entire board of the company and takes over the control and the management of the company. Then number two is a temporary moratorium on the rights of claimants against the company in respect of any property that the company has in its possession, and also a moratorium on all litigation. So if somebody has sued the company, that means that the moment the company goes into business rescue, everything stops for the duration of the business rescue. Then number three, it involves, because that's the ultimate goal with business rescue, is to prepare a plan to rescue the company by restructuring its affairs, business, property, debt, and other liabilities and equity in a manner that maximizes the likelihood of the company's continuance in existence. So what business rescue in effect comes down to is you take the company, and if ultimately it looks like it is a viable option to rescue that company, that it can actually make it still, then that is what you do. But then somebody has to step in and take over, because the board has obviously not been able to do so. So when can a company go into business rescue? When it appears unlikely that the company will be able to pay off all of its debts as they become due and payable within the immediate following 6 months thereafter. And I think that is going to be very relevant to all businesses in South Africa the moment we come out of this lockdown, because everybody is going to be so depleted of cash, and they're not going to know whether they're coming or going, or whether they will be able to meet their obligations for the next 6 months. So how do you go into business rescue? It's two ways. Either by way of a board resolution, which is then registered with the registrar of companies, and the moment it is registered, the company is in business rescue. And if the directors themselves, the board, doesn't want to do it, then a creditor can apply to have the company placed into business rescue by an application to court for a court order. And the company is then placed in business rescue by way of a court order. How long does business rescue last? The intention is not for business rescue to last very long. There's a prescribed period of 3 months, because remember, in the period of business rescue, the intention is that you must prepare that business rescue plan, which is designed to give a plan for the company moving forward. Now, it can also be extended. What happens in this period? Of course, as I've said previously, there's a moratorium on all legal action, and all of this allows the company some breathing space. Then, of course, there are meetings with creditors, and the creditors all have to vote for the business rescue plan. They all have to be on board. They will be asked to accept reduced payments, whether it is reduced capital, whether it will be reduced monthly payments, but that is the intention, and everybody will have to work together in order to rescue this company. Now, of course, it is always much better for a creditor to rather receive something than nothing. And the reality is, if the company goes into liquidation and a creditor doesn't play ball, then of course that company is going to go into liquidation, and then the creditor is most likely going to get very, very little refunds from the company, if anything. Whereas in business rescue, you might have to wait, but he will most likely get the bulk of his claim paid ultimately. But they have to work together, and they have to work together with the business rescuer. Now, what is the plan, the business rescue plan? Because that is what will determine how the company will be dealt with going forward. The aim is to reorganize and restructure the business with the aim of returning it to a more stable and profitable entity. So that is what you want to achieve with a business rescue. Business rescue has not been in South Africa for very long. It was previously it was called judicial management, only applicable to certain big companies, certain big debts, very formal court process. It's much easier now. But the problem is that international evidence shows that only about 5% of business rescue cases are successful. Many companies choose to go into business rescue because they don't want to face the reality that their company is going down the drain. Sorry for the expression, but that is what it is. And they have to face up to it. They go into business rescue and they try to keep a dead horse alive for as long as it can. Sometimes it can be resuscitated, and really business rescue should only be used where it can be resuscitated. Otherwise, you're wasting everybody's time, money, and resources, because remember, the business rescue practitioner also has to be paid, and they don't come cheap. So that is business rescue in a nutshell for you.
Thanks, Marina. One of the questions that I've just seen popped up through our chat line, and if I know it's not the question section, but I think it's very valid to the business rescue point and to the big three aspects that businesses need to look at. And I'll quickly ask both of you to maybe just give a comment, is what can I do, or do I need to change anything currently? Thinking of COVID-19, what is some literal 1 or 2 points that I can practically do now to try and see if I'm heading in the wrong direction? And what can I do practically now to save my business? Maybe Marina, you first?
Yeah. Well, I would say that is actually an answer for such a business rescuer. But of course, we limit your expenses as much as you can at the moment, but with parameters of the law, if you can. It really depends on what is required and what the overheads will be. But you have to factor it ultimately, if you can. But
what I'm hearing is just saying is take ownership and assess your information. Partner with somebody that has detail with this so that they can give you insight prior to the fact that you maybe have to do this, so that you can see what you can do already right now. Melanie, maybe just quickly back to you from a business rescue perspective in the big three. Obviously, if things are going a little bit crazy and your finances all over, you're not generating any income, for instance, in construction, which is only going to get down out of lockdown on level 2, there is a lot of things that needs to look different. We are basing the big three on financial statements. So am I assuming correct that that will have an effect on the big three?
I think that financial statements specifically are always rather reactive. So your financial statements shows a picture that already happened. So very often it's very important for you to get a good partner and to get great advice now, because what is happening now will only reflect in your future set of financial statements. So that's where the element of advice and bouncing off some ideas with people who understand your business and your industry is going to be rather important. So I don't think that the financial statements in itself will at this stage in time be a good barometer of the health of the business, because it's got a little bit of a time lag. I would also say that your buy and sell agreements are still going to be important, unless you don't want to sell your shareholding when something happens to you. You also have to go and have a look at what is your credit loan accounts, and I think Marina will refer to that at a later stage in time. If the business is going south, then what is going to happen to those credit loan accounts? So start thinking about the implications of the business becoming sicker and sicker and sicker. The other thing is, I think it might now be time to scrutinize those surety agreements that you have signed. And yet again, get some advice from somebody that understands those surety agreements, because let's be honest, I very often see this. A client, in the sense of business, wants to get that facility. They don't necessarily think of the downside 3 or 4 or 5 years down the line. And very often clients sign surety agreements without understanding the content of those specific surety agreements. So I would really think that clients must now go and scrutinize, do the homework, and look at every sentence that is incorporated in that specific surety agreement that you have signed, and most of all, get advice and get assistance and get help before it's too late.
So, Melanie, I think what I'm hearing from you there is that you're not necessarily going to make major changes while you're going or planning for or going into a business rescue process. You're going to keep your policies dry and make sure, because that will be, from a security perspective, what the bank will require in the event that something happens. I don't want to waste too much time, so let's get into probably the harshest topic that we will have today, and that's liquidation. So Marina, I mean, let's be real. We've just spoken about SAA, and we are probably going to see liquidation as one of the biggest topics that's going to come for the rest of 2020. So maybe you can spend some time, and Melanie, I want to ask if you two can maybe have a chat about liquidation. Just give us an idea about the pros, the cons, the impact that it will have with us.
Absolutely, no problem. Now, of course, if a company is liquidated, it can happen in one of two ways. Also by way of a resolution, which is registered, or by way of a court order. I'm not going to bother you with the details of how that must all come about for that to happen, but I will tell you what is the net effect of liquidation. Ultimately, when a company is liquidated, the following is the net effect. All debts of the company, that includes all debts, including SARS debt, which is most important, falls within the estate. The liquidator is appointed and he must deal with it. You literally do not have to answer those calls anymore. You give them the liquidator's telephone number and that's the end of the problem. Contracts still alive can be transferred with consent of a liquidator and the client. You pretty much get rid of the bad and you keep the good if you have a good litigator on board. Liquidation is, for me personally, not everybody agrees with me, but I've always seen it, and I've been a liquidation practitioner for quite a number of years. I've always seen it as a commercial decision. It is not an emotional or a reputational one. It affords you relief when needed most. Now, the pros of liquidation: the company debts disappear, no more taxes. You start with a clean slate. You can literally go and register a new company with the same trading as name as the previous company, which has just been liquidated. And so your customers don't even need to know that the previous company has been liquidated. Of course, if they're going to get the invoices at the end of the month, they might see that there is a new VAT number and a new entity number, but the trading as name can remain the same. Then if you manage the process very well, and this is really the most important part of liquidation, is to get the right liquidator appointed. Unfortunately, that decision is not always in the hands of the people who brings the application for liquidation, because the master makes the appointment. But if you get the right liquidator appointed, you can make deals with that liquidator, such as to buy your assets back from the liquidator and to carry on in a new entity seamlessly. Cons of liquidation: ongoing contracts are terminated. Personal liability for directors, if not managed correctly. That is pretty much the biggest problem with liquidations, but only in certain circumstances. Continuity of the company disappears, so you have to start with a new company. Then, of course, something that Melanie has mentioned, which we have to discuss a bit further, is suretyships will sink you. If you signed those suretyships, it's not going to help that you've liquidated that company if you've signed suretyship for most of the debts. That is now falling into the estate. And then another big, very unpleasant part of it is there might be a possible interrogation of directors in what we call insolvency inquiry. That happens very seldom, and I've not seen SARS have those inquiries. That's always a big question. It's very seldom that they do have those inquiries. So yes, just to get back to suretyships and how that latches on to what Melanie has mentioned. Of course, if you sign suretyship for a company's debt, then it doesn't matter if the company is liquidated. The company's creditors can still proceed against you as a surety for the full amount of the suretyship that you've signed for. Melanie, perhaps you can just tell us. I doubt that this is available, but maybe there is. Is there any possibility that you can take out the same insurance for the suretyship debt, like you can do in the event of death of the person who signed that suretyship in the event of liquidation. In other words, that's such a trigger event.
And when we look at insurance specifically, insurance has got a trigger event. And that trigger event would usually be something like death or severe illness or something like a trauma or a disability. So that is the difficult thing. Usually when a company goes into liquidation, you have the problem that you still remain as a surety, possibly liable in your personal capacity, but there's no trigger event yet, which would be problematic. Almost certainly, if you then continue in another entity, then obviously, and sign sureties there, then that is important. But the trigger event, when you insure against the risk in our specific world, is usually going to be that something happens to you. So there must be a trigger event regarding your health specifically, or you have contracted a disease and you are no longer there. So that's the unfortunate element that we have to keep in mind.
And that's something that business owners really have to take into consideration, because I've had many liquidations, and the first question I always ask my clients are, where are your suretyships? Show me the suretyships that you've signed. And mostly, more often than not, they're very surprised at that question. But that really is the point of departure for every liquidation, is to determine what you're going to be liable for in terms of personal suretyships also.
Marina, maybe I can just quickly come in here, and this is just on a higher note so that we don't get so depressed. But trigger events won't be when you tell the client that he doesn't have any cover or something is in place, that he has a heart attack and then triggers the policy. But let's get back over to you and continue on liquidation. Thank you.
Yeah, so well, that's pretty much that on liquidation. I'm absolutely pro liquidation because it brings finality. That's the one big thing. And you don't have to get the consent of the creditors and ask everybody to cooperate and just to bring this about. You can, of course, it takes care of your labor problems also. If you absolutely overextended from labor problems, that's the end of it. All creditors fall into this insolvency state, including any awards by any labor council, CCMA, arbitration commission, doesn't matter. It all falls into the insolvency state. You literally walk out of that. Now, of course, for those kind of things and for tax, you don't sign personal surety, so that will pretty much be the end of it. There are specific sections of the tax law that provides for certain instances where directors can be held personally liable for tax in certain events. It, however, hardly ever happens that SARS enforces those. I've never seen it happen. Of course, in the big liquidations like the King, I don't know if you remember that King big VAT fraud that he's committed. Of course, they SARS have those inquiries, and then that becomes very relevant, and the intention is to hold the directors personally liable. Very important for business people is you need to realize that you're not allowed to trade in insolvent circumstances. The moment you trade in insolvent circumstances, then the company becomes factually insolvent, and that is a problem, because then anybody can apply for the liquidation of the company. You might not think the company is insolvent, but it might actually be. And then if I can just latch on to the next issue, which is shareholders' loan accounts, and why that is also important for purposes of insolvency. When you provide finance to your business through a credit loan account, most likely you're going to be the biggest creditor of that company. Now, if you've loaned R1 million to the company and the company has assets of 600,000 Rand on the books, on the annual financial statements, that company is going to be shown to be insolvent. And for that reason, it is quite important that business people then state in their shareholders' agreements that their claims will be what will you call it? Let me just get the correct, subordinated to other creditors' claims. In other words, all other creditors have to be paid first before a shareholder's loan account will be paid. Otherwise, if you don't do that, the company will be considered to be trading in insolvent circumstances. So that is the reason why that is done. Can I proceed further with how a shareholders loan account is treated in insolvent estate, Conrad?
Yeah, sure. We've got a few extra minutes, so go ahead.
All right. So that pretty much means, and if you look at your annual financial statements, normally in the annual financial statements, the shareholders loan is recorded as unsecured, bears no interest, and is repayable on demand. And then if your loan account has been subordinated to creditors, then that will be in the shareholders agreement. You get 3 types of claims against an insolvent estate: secured, preferent, and concurrent. Now, secured and preferent is the place to be, but unfortunately, a shareholder's loan account is not either one of those. Loan accounts are always concurrent, and of course, you rank on the 3rd level of creditors of the insolvent estate when it comes to the payment. Your claim must be proved like any other claim. If your claim is subordinated, all of the creditors have to be paid in full first. So you have to keep track of that also. And then otherwise, if your claim is not being subordinated in your shareholders agreement, then you are a normal creditor. But there is one exception: you may not vote for a liquidator to be appointed on the first meeting of creditors. Other than that, you're a normal creditor, but still a concurrent creditor standing 3rd in line with the other creditors. So that is the effect of the shareholders loan. What happens to that in the event of liquidation of the company? So it's important to see in your shareholders agreement how your loan account is treated. Right. I hope that makes things clear.
It does. Thank you very much, Marina. So while we ask for everybody to just, if you have some questions, go ahead and just pop it. I'm seeing a few questions coming up, and I will try and get to all of the questions. But maybe we can just spend the time a little bit on, Melanie, on the fact of what I'm hearing is that this is a complex world, managing a business risk. And what you want to have is a team of specialists that actually work with you. Each one has their own role. So it's not just one person fits the boot for all the food. You need to really, really understand that they're specialists in these fields, and each of them has their own way to look at it. Looking at that, I'm hearing that every time that something happens to your business, you have to look at your big 3 because it has an impact on that. Melanie, maybe you can just take a minute to agree or disagree with me.
Yeah, it's like everything in life. When things change, if it's internally or if it's externally, you have to do a bit of a tweaking and an adjustment to see to the fact that you are adequately prepared. I actually wanted to ask Marina a question, if I can. I'm sitting here and considering those sureties, which is number 3. I'm now thinking that in the next session, I must actually pull that up to number 1. And I was wondering, do you see different variations of surety agreements that clients sign on behalf of their specific entities? So is there maybe a way that a client could be more protected in one type of surety agreement than they would be in another type of surety agreement? Could there be variations in clauses and structuring?
Oh, yes, absolutely, Melanie. The first thing that's why I always ask for the suretyship agreements first, to first determine whether they're actually legal and enforceable, because the rules applicable to the enforceability of suretyships are very, very stringent. So I'm not going to bother you with the details, but you really have to consider the entire suretyship agreement for that purpose. Then number 2, my suggestion to any person would be limit your suretyship. Don't keep it open-ended. Many banks will not want to do that, but if you can, try to negotiate a limited suretyship so that you know, I'm in this for 200,000 or in this for 500,000 and nothing more. And that even if the company is afforded credit to the tune of 2 million, they cannot claim more than my limited suretyship. So rather have the hard negotiations when you negotiate that, because that's quite important. That will also prevent nasty surprises down the road.
Melanie, if you want to comment again.
No, I think that's actually valid because you also get the instances, as I mentioned before, of clients that really don't know what type of suretyship they have signed. They don't know whether it's capped or whether it's open-ended. And I think this is now maybe the time to sit down and have a look at those suretyships that you've actually signed. I always smile because I ask clients for their wills and they go hunting around and they don't immediately know where to find it, strangely enough. But the same now should obviously apply with those surety agreements. I'm just wondering how many clients can quickly and efficiently lay their hand on that surety agreement that they've actually signed. So we need to scrutinize those agreements to know if things do get worse, what's the implications going to be for your personal estate? Because your personal estate, when you're a business owner and your business entity cannot be completely divorced. And I always say that there are two bridges between your personal estate and your business entity. And the one lever being those credit loan accounts, because you become a creditor for your specific entity, and the other one being the surety that you've signed. So those two levers actually lift the veil between your personal estate and your business estate. So it goes further than just looking at, is your business going to succeed? It is your business going to exceed, and is your personal estate going to survive as well?
Yes, yes. Well, Melanie, Marina, I wanna say thank you and maybe just do a small closing. I see a few questions also coming in, and we're sadly running out of time. But to maybe in the closing try and answer some of these, is that what I'm hearing is what they're asking, what are we needing to do? What do we prepare? And I think indirectly you've just answered the question. Start getting and finding those contracts with your suretyship. Find your memorandum of incorporation of how you started your company. Get your trust deeds sorted out if your company is connected to a trust. Get your personal finances to a state where you actually know what's going on in your personal finances, both personal and business. And then take all of that and go sit down with a bunch of specialist people that understand and can support you in what actions to take. Because one situation is not necessarily the answer. I mean, we've spoken about quite a few things here, but the variety of how this can look is so difficult to just give in a webinar, give the answer to it. So the idea is to say, sit around a table and look at your unique situation and actually answer that. So I think to our visitors and our guests on the webinar, please tune in, find us on Facebook, find us on LinkedIn, because we do paste our next webinars on there with the events and the dates. We'll be having more chats definitely with Melanie, and see if Marina is available to also connect with us. We'll be looking at some items like benefits, medical schemes. We'll be looking at short-term insurance. And we want to ask you to just join in and see how we can aid you even further. Connect us by hello@thefirebird.co.za or connect with us at moneymatch.co.za and go meet the team. To everybody, thank you very much for joining. Go have a lovely lunch, and we look forward to creating something that matters with you in the future. Thank you so much.
Thank you, Conrad.